Historically, a bank panic was a physical event. Driven by visceral fear, masses of customers queued outside brick-and-mortar branches, demanding their cash. Modern digital panics operate at a terrifying speed. Today, billions of dollars can flee a bank within a fraction of that time, entirely online. A bank run occurs when a sudden wave of customer withdrawals overwhelms a deposit-taking institution's available liquidity. Technical failure usually stems from a simple exhaustion of immediate cash reserves, which can occur even when the institution's long-term loan book is perfectly sound. Looking at collapses like Northern Rock in 2007 or Silicon Valley Bank in 2023 shows exactly how this mechanical liquidity crisis operates. To understand how perfectly solvent banks collapse overnight, we must look past the human panic and dissect the mathematical mismatch hidden on their balance sheets. The core business model of banking is financial intermediation. This means a bank borrows short-term deposits from savers to make long-term loans to borrowers. This chart shows a basic commercial bank balance sheet, organized as a T account. The left side shows the bank's assets, like cash, loans, and bonds. The right side shows its liabilities, primarily customer deposits, with equity sitting at the bottom. Look at the cash block on the asset side. Cash is perfectly safe and instantly available to hand back to depositors, but it generates zero profit for the bank. To survive, pay interest to depositors, and generate a return for shareholders, banks must deploy most of that cash into less liquid, higher-yielding assets, like mortgages or government bonds. This creates an inherent operational paradox. Optimizing entirely for liquidity starves the bank of profit, but optimizing for profit leaves the bank exposed to cash shortages. Fractional reserve banking operates on an inherent duration mismatch. The system relies mathematically on the assumption that not everyone will ask for their money back at the exact same time. Silicon Valley Bank, or SVB, operated in a highly specific niche. They banked primarily for tech startups that were regularly flushed with cash from venture capitalists. This is a chart showing SVB's balance sheet leading up to 2023. Notice how the liabilities column surged upward massively as billions of dollars in short-term startup deposits flooded into the bank. SVB could not find enough traditional loans to absorb this massive influx of cash. To generate a return, they converted those cash reserves into long-term government bonds. These were classified as held-to-maturity, or HTM, bonds. HTM is an accounting category for assets a bank intends to keep until they pay out entirely, which legally shields their paper value from daily market fluctuations. Even the safest assets in the world, like U.S. government bonds, become a fatal vulnerability if the bank's duration mismatch is too extreme. The trigger for the crisis was external. The macroeconomic environment shifted sharply as global interest rates were aggressively hiked to combat inflation. This graph illustrates the iron law of bond markets. As new interest rates rise, the market value of older, lower-yielding bonds inversely plummets. Venture capitalists recognized this specific vulnerability on SVB's balance sheet. They warned their portfolio companies, initiating a digital stampede for the exits. This is SVB's T account during the panic. Customers demanded a staggering $42 billion in a single day. That volume of withdrawals instantly drained SVB's available cash reserves to zero. To pay the remaining withdrawal requests, SVB had to break the glass. They were forced to sell those held-to-maturity bonds immediately, realizing the steep losses dictated by the newly depressed market prices. Selling those bonds materialized the paper losses. That loss cascaded down the balance sheet and completely wiped out the bank's regulatory capital, which is the equity buffer required by law to remain legally open. A psychological panic forced SVB to realize massive paper losses, mechanically transforming an illiquid bank into an insolvent one. If human panic can destroy a perfectly solvent bank, the entire fractional reserve system is vulnerable to cascading contagion, where fear spreads from one institution to the next. This diagram shows the first systemic circuit breaker, state-backed deposit insurance, like that provided by the FDIC. The FDIC, or Federal Deposit Insurance Corporation, is a government agency that provides insurance to depositors to maintain public confidence in the financial system. By guaranteeing deposits up to a specific limit, regulators remove the rational incentive for retail customers to join a bank run. For massive, uninsured institutional runs, the system requires a second defense mechanism, the central bank, acting as the lender of last resort. These government institutions exist specifically to short-circuit human fear. When a private bank's trust completely evaporates, the central bank steps in to substitute the state's infinite liquidity. To stop the 2023 panic from spreading beyond SVB, the Federal Reserve launched an emergency response called the Bank Term Funding Program, or BTFP. The BTFP is a temporary emergency lending facility that allows banks to access cash without selling their assets at a loss. This chart shows the mechanics of the BTFP. It allowed banks to borrow cash using devalued government bonds as collateral at their original par value. Par value is the face value, representing the amount paid back at maturity, regardless of market fluctuations. This specific lending facility directly neutralized the exact vulnerability that killed SVB. Banks no longer had to liquidate their bonds at a loss to satisfy withdrawals. We have seen extreme systemic interventions before. In 1933, President Franklin D. Roosevelt instituted a national bank holiday, physically locking the doors to forcibly pause the panic and allow banks to resupply their cash. The manual interventions of the 1930s contrast sharply with the reality of modern banking, which requires instant, multi-billion-dollar digital liquidity facilities to halt a panic. Modern banking relies on a mathematically engineered structure of duration mismatches, yet the entire system rests on the fragile psychological state of public trust.